Good afternoon, everybody. Thank you for attending today's webinar. I'm your host, Michael Episcope. I'm one of the principals and co-founders of Origin Investment. The purpose of today's webinar is to, are we there? I saw the screen just go up, so I think maybe I jumped the gun there on this part. But the purpose of today's webinar is to go into detail about Elan Pikes Peak, our latest QOZ opportunity, a deal that we are very excited about. We are going to cover the market overview, talk about Colorado Springs, why we like that market. We're going to go into detail about the project construction and timelines and share details about our underwriting, some stress tests, and the opportunity itself. And most importantly, talk about how you can participate in the deal as well. The whole webinar will be about 1 hour, of which the presentation will be 40 minutes, and we're going to leave the last 20 minutes open for a live question and answer session. And we did questions in advance, and we thank you for those, and we'll try to answer those throughout the presentation, but anything we don't get to, we will answer at the end as well. And if you're new to Zoom and you don't know how to do this, there is a question and answer box. So if you need some, if you have a question, please just put it in there and we'll get to it right at the end in the order in which they are received. Joining me today are two speakers, Tom Briney of Origin Investments and Bo Chapman of Greystar Real Estate Partners. Tom and Bo are both the respective experts on this opportunity and are going to give a detailed overview of the project itself. So welcome, both of you. Bo is the Managing Director of Development for Greystar Real Estate Partners and responsible for the Mountain Region development business, including the sourcing, capitalization, execution of multifamily development. He is a licensed professional engineer and has been active in the real estate industry since 2007. Bo, welcome today. It's great to have you here, and I know I speak for everyone at Origin when I say we are excited about partnering with you and the entire Greystar team on this deal.
Thank you, Michael. Happy to be here.
Tom Briney is also joining us, and he is Origin's Director of Acquisitions for the Western US, and he is really the reason why we are all sitting here today. He lives in Denver and sourced this opportunity on behalf of Origin. Tom has a total of 13 years of experience in the commercial real estate industry, and 9 of those have been spent with Origin. And it has personally been a pleasure watching Tom grow and develop both personally and professionally for the last 9 years. And if I have to describe Tom, I would say that Tom is one of the most driven and focused people I've ever met, and is one of these individuals who just excels in everything he does. And I'll never forget when we first interviewed, is he had these stories of success after success, and he's brought that from his personal life also into his professional life. Tom was a Division I football player that had an early ending to his career there, but then went on to join the ski team and quickly became the captain of the ski team within 1 year. After he left college, he decided to take up bicycle riding, and within a few years, he was wheel to wheel with other pros in the industry. He took that into his professional career very early on as well, and this attitude about winning, but certainly not winning at all costs. Tom is an incredible teammate, somebody who's very humble. Tom originally cut his teeth at JP Morgan and then jumped to Equity Office, where he became a top analyst there. And then he moved over to Origin Investments. And that pattern of his success in both his personal and professional life has persisted for the last 9 years here. Tom started as an analyst, quickly moved into asset management, became vice president within that department, and then became an acquisition officer and very quickly became prolific in that role. And today, Tom is responsible, he's a director, and he's responsible for sourcing deals in the entire western half of the US on behalf of Origin Investments. And he's well respected by all team members of the firm. And as I said before, he's an incredibly humble individual, and we're lucky to have him. So great to have him here as well to share the personal details about Elan Pikes Peak.
Thanks, Michael. Happy to be here.
I'll go into a little bit about Origin. We have both current and prospective investors today on the webinar, and I'll spend a few minutes on this for those of you who may not be familiar with Origin. At our core, we are a real estate investment firm, and we bring institutional quality real estate investments to family offices, individuals, registered investment advisors to help them continue to build wealth and generate passive income streams. And we typically operate through fund structures. We've operated a total of 5 funds to date. 2 of them which are open, the Income Plus Fund and QOZ funds. And we have had a lot of success in the last 13 years. We have had the honor of twice being named a top decile manager. And most recently, we were named a top consistent performing manager by Preqin, which is a third-party evaluator of fund investment managers. We are headquartered in Chicago. We have 4 offices around the country. One of them is in Denver, to which Tom covers. And we do everything from acquiring existing projects in the core plus and value add areas to ground up development. And today we own and operate close to around 4,000 apartment units around the country. And we've executed more than 2 billion in deals. And I'm proud to say that we represent more than 1,200 investment partners at the firm. The team, I'd be remiss if I didn't talk about the rest of the team members at Origin as well. This is really the heartbeat of the company. And we have 33 dedicated team members across a multitude of departments that not only help produce great returns for our investors, but also ensure that the entire investment experience, from the due diligence to signing of the documents to ongoing reporting, is the most positive experience it can possibly be. And the reason why we do that, because this is what we expect as investors ourselves. My partner and I built this firm around our own capital. And when you sit in the investment management seat and you have a significant amount of your own money in deals in the firm, it really provides you with a very unique perspective on how to build a firm. So we've always been very balanced between us as an investment management firm and the how we view the investor experience as well, and have put a lot of time and effort into that, because it's our belief that to win in the long run, you have to focus on quality over volume, and quality extends into everything we do. And when we bring a deal like this to the market or approve it for the fund, it's because of our conviction in the deal. And Elan is one that we strongly believe in, are excited to be both adding to the fund and bringing it out as a sidecar opportunity as well. Let me jump in, and I'm going to talk very high level about Elan itself, why I liked it, why my partner liked it, why we approved it at credit committee, and certainly why others at the firm also like it as well, and why it's getting traction amongst our investment community. When Tom initially brought this deal to credit committee, we were all immediately interested based on the location alone. And if you've been following us in our writings, you'll know that we believe in a post-COVID world that lifestyle communities will benefit, that areas like Colorado Springs, like Denver, Austin, Orlando, places like that, as you get this virtualization of the workforce, you get more mobility for workers themselves, and people are going to choose different cities than they may have otherwise a year ago. And Colorado Springs not only fits that bill, but on top of that, you have things happening in Denver, which is actually pushing the demographics south. You have all the growing pains that you get with a dynamic city like Denver that has seen exponential growth. You have higher commute times, you have traffic jams, you have things like that. And so that experience is really pushing people to the south. And Colorado Springs, as a result, is seeing just a massive influx of people and huge demand like no other city in the country right now. And the analogy I would give is Colorado Springs is like where Denver was 10 to 15 years ago, and it has all the characteristics of being right there on the Front Range. Just an absolute beautiful community, close to skiing, mountains, everything that you want. What we really love about Elan, and these are things we look for in any deal, is it checked every box out there. It's a lifestyle city with growing demand. The deal at high development margins, and we look at hundreds of deals around the country. This has a return on cost of 6.6%. And I'm not going to get into details about what that is for those of you who are in real estate. you understand that concept. Tom can go into this in a little more detail. We just don't see developments with that kind of margin built into them in cities like this with this kind of wind at their back. This also has the financial support and backing from the city of Colorado Springs. My opinion, it's conservatively underwritten as well. And I think the base case, and we believe that it's more than realistic, and Tom will talk about that in more detail as well. And the most important thing is that we have a great partner in this deal in Greystar, and we're excited to be partnering with them, but the team here couldn't be better. And I'll just say that rarely do all the stars line up in a deal, and this is about as close as you can get it with Elan Pikes Peak. And it's the reason why we're bringing this sidecar to the community, because it checks all those boxes. Now, one of the reasons, and this is a question that came in, why are we making this a sidecar, just putting it into the fund? And the reality is that it's just too big. This is a $95 million deal, requires $32 million of equity. And the fund typically does deals between $10 and $20 million. So we actually need to downsize the deal in order to right size the fund. And the fund will be doing about $17 million, and the sidecar will be doing about $15 million here in this. Now, I do want to mention that, like all of our sidecar opportunities, our current investors, specifically our QOZ investors and then investors in other funds, will have priority over everybody else. But if you're interested, current investor, QOZ, a non-current investor, and you have interest, please contact your Origin rep, provide an indication of interest, because this is a deal that we believe will sell out rather quickly. It'll be fully subscribed. And as of today, we already have interest in more than about 55% of the deal, and we just announced it a few days ago. So please call your rep, provide an indication of interest. You'll have a week to review the documents, and we'll do what we can to allocate an interest to you. And you can access all of the documents for this deal on the portal. If you're not registered, please register. Go into there. You'll see under offerings an Elan Pikes Peak page. You can see the investment brochure, the PPM, all the details of the deal, and you can contact your Origin rep from there. And the last thing I'll cover before I hand this off to Tom is just the fact that this deal does meet all of the QOZ requirements, and it allows individuals to defer, reduce, and eliminate taxes so long as they are investing with capital gains. And the benefits to this are the same whether you choose to invest directly into the deal or our fund. We would actually prefer that people invest in the fund because it's diversified across a number of geographies, a number of deals. You will get access to this deal as well, but we also understand that sometimes people just want exposure to an individual deal itself and they don't want to be in the fund, or they want to be in both. So that's the end. Oh, the last thing I was going to say, so the chart you're looking at, what you'll see, and those of you who may not be as familiar with QOZ law, is that if you invest by the end of this year, you get a 10% step up in basis, which means basically your capital gains is reduced. So if you owed $1 million in capital gains, that will be reduced by 10%. You only owe $900,000 in a tax obligation. You also get the tax deferral so that those taxes aren't due until 2026, payable in 2027. And then of course you get the tax elimination so long as you are in the deal for 10 years or more. So with that, that is my part. Hopefully I covered everything and teed up the project here and a little bit about why we liked it. I'm going to hand this over to Tom, who's then going to hand it over to Bo. So Tom, take it away.
Thanks, Michael. Let's talk about the deal. This one was a really long time coming. I've been spent about 2 years in Colorado Springs hunting for the right opportunities, and really a lot of them that I was coming across weren't quite meeting our return expectations. And again, as Michael alluded, we try really hard to be fair with our underwriting. He would suggest, and I would agree, that it's sometimes even conservative. And so it's been a really hard challenge to just find the right opportunities in the Colorado Springs. So over the last 2 years, I've been learning the market extremely closely, meeting with all the local partners and developers and the local folks who spend all day, every day in real estate in Colorado Springs trying to find the right opportunity. Concurrently with that, we spent the last year plus developing a really strong working relationship with Greystar. We've been looking at development deals all around the country with them, and have been focused on trying to find the right opportunity with them to really codify the relationship and start what is hopefully going to be a very long-lasting partnership between the two firms. This deal brings all of that together. It's the right deal with the right returns with the right partner, and we're really excited to get it off the ground. So why is it that I like this deal so much? Let's start with the market at a high level. Colorado Springs has had a tremendous amount of growth that Michael was alluding to really in the last 3 years. We've seen an inflow of more than 60,000 people and the creation of more than 35,000 jobs, really in just the past couple, 2 or 3 years combined. A lot of that population movement is in migration from California, Texas, all over different parts of the nation, as well as Denver. As Michael alluded, there are some growing pains in Denver. I live here. I've seen it in just the 5 years that I've been in town here. The commute times are up. The cost of housing is up. And people with the work from home shift are taking that opportunity to accelerate their movement to Colorado Springs. It's a lower cost alternative to Denver. And it's got everything that Denver has to offer, from access to the mountains. Your drive time to Breckenridge or Vail is very similar to what the drive time is from Denver, but without traffic. If you add traffic to the equation, your drive time could be 3x of what it would be when you're leaving from Denver versus when you're leaving from Colorado Springs. So it's a much closer location. The traffic is less, the cost is less. And as a result, people are moving from all over the country to be in Colorado Springs. As I think Michael had up on a previous page, it was listed as the #1 city to live in 2019. The job growth there as well is real. Amazon has broken ground and is building a 4 million square foot distribution center. It's going to be one of the first 4-story distribution warehouses in the country, and will be their largest distribution center in the country when it's complete later this year or early next year. Next to that is Aerospace Corp, based out of California. It's an aerospace engineering firm. Just announced a $100 million development that's almost adjacent to Amazon's facility. That'll create 200 very high quality engineering R&D type jobs. And there's story after story after story of these types of jobs being created in Colorado Springs. So when you've got the in-migration from the higher cost California, you've got the proximity to Denver where people can commute and work from home if they need to, but at a lower cost, and you've got real jobs that are being created. It's got all the formula for a highly successful real estate investment. And then what's really been catalyzing the downtown revitalization are 2 big projects that are underway right now. The first is the U.S. Olympic Museum, which really anchors the western part of downtown Colorado Springs. This was opened in the last 30 or 60 days. It's really a cool new way to commemorate and really patriotize the sports history that is U.S. Olympic history of the United States. And the other component is the Colorado Switchbacks Soccer Stadium. So that is a notch below the top tier of the Major League Soccer system. They're building a brand new stadium just to the south of the U.S. Olympic Museum. And those 2 pieces combined will create the anchor for a new mixed-use, walkable, pedestrian-friendly downtown Colorado Springs. That will anchor the western side of the city. And then let's talk specifically about our site, which is on the eastern edge. It's about 6 blocks away from those 2 catalytic drivers that I was mentioning. And this will really act as a tremendous anchor to the east for the downtown revitalization and growth that is currently underway right now. What really gets me excited about our location is, first, just about 100 yards, 150 yards to the east of us is what's called the Catalyst Campus. This is really an incubator for technology and startup companies that want to be in the Springs. You've got several colleges and universities in the Springs that then can send their highly entrepreneurial, highly qualified, and highly motivated individuals to this Catalyst Campus, and they can start the next generation of things that I can't imagine. The technology, the apps, the things that are way above my pay grade are being created in this Catalyst Campus every day. That's just 150, 200 yards to the east. To the west by 2 blocks is the main nightlife in downtown Colorado Springs. You've got the restaurants, the nightlife, the bars, the jobs, everything that you want in a work-life balance. This is the lifestyle city that Michael was talking about, is within walking distance of your front door of this project. So it's a really cool, unique location that will anchor the other side of downtown and will really help build the entire community together between the western edge, the US Olympic and the stadium, and then our edge, Catalyst and Elan Pikes Peak. And then to top it all off, you still have tremendous access. You're 5 blocks from the freeway that takes you to the mountains, and you've got tremendous access to mountain biking, hiking, kayaking, all the things that make Colorado great, the 300 days of sunshine. You're very, very short drive away from all of that stuff. So the project itself, I'll just give you a little teaser and then Bo will jump into it a little bit further. It'll be a 322 unit project, a mix of studios, 1 and 2 bedroom units. And it's really gonna be an amenity leading project. So there have been 4 really new projects developed in the last 3 to 4 years. This will be number 5. And those have all leased up extremely quickly without the amenities and without the quality that is being programmed here. And so with that, and before I take too much of your thunder, Bo, why don't you talk about Greystar a little bit and then jump into the exciting design that you've created here.
Absolutely. No, thanks, Tom. And just for the audience's benefit, Tom and I jockeyed over who got to talk about the market. We've got pages and pages of notes and a lot of conviction, and we really are really bullish on Colorado Springs, especially given, you know, our home base in Denver. So, but I'll let you have the limelight for that piece, and I'll focus on the development, Tom. But first things first, let me tell you guys a little bit about Greystar in case you're unfamiliar. We operate under kind of a 3 business line structure. One is the operations business. That's where we operate and manage apartments across the globe, really. Domestically, it's about 600 beds or units. And then out of the Denver office, we're pushing close to 40,000 units of management out of the Denver office. So we have a great team of local professionals and managers that we really rely on for data, best practices, and a lot of those things that really set us apart from our competitors. Under management, in terms of the investment and acquisition side, we've got about $37 billion AUM. And then where the rubber hits the road, at least for our business for my team in Denver, is the development construction side. We've got about $15 billion of active development projects and an even deeper pipeline. And like Tom said, the thing that really gives us goosebumps about this one are the spreads. There's not many places across the country where we have influence and insight, where we're seeing the returns that we're seeing in the Springs. And so to have the right timing of, you know, public incentive, proof of concept in the rental market, the migration story, all that coming together at the right time really gets us excited about this project. If we could build more units, we would build more units. But the 2-acre site that we've got still gives us a pretty good institutional size deal, which we're excited about. As far as kind of our role in this process, just for your benefit, we're cradle to grave. We don't hand off a deal at a certain stage and kind of introduce opportunities for value void in a project. Myself, Melissa Ricksecker, and our team from Denver are going to be intimately involved with this project, from really site sourcing all the way through disposition. And so right now we're about this 3rd bubble. Hopefully soon we'll be under construction and then kind of day-to-day be operating the project in that fashion. Moving on to the next slide. One of the other benefits of Greystar is that we don't really attack a singular food group. The only thing that's consistent in what we approach is really rental housing. And it comes in a variety of different forms. And so it allows us to build the highest and best use and build to the opportunity. Sometimes that's through kind of leveraging success at a competitive project or playing into a void. And so we really pride ourselves, and our investment committees are thankful for their support in allowing us to really, through kind of our in-market knowledge, present an investment thesis that really kind of gets you to the best NOI and ultimately to a successful project. So, and that spans from age-restricted housing, conventional market rate, garden communities, and obviously the ultra high-end type 1 buildings too. In terms of kind of our big idea and inspiration for the project, it's really inspired by balance, wellness, and flexibility. I mean, it's one of the more active cities in all of the central US and one that we develop in. It's Olympic City, USA. This is an active resident base. I mean, not many places in the country you can be downtown, get on your bike, and in 10 minutes be in the foothills. And so we want to carry that character into the building. And so you see a lot of our themes, a lot of our programming and amenities really serve that intent of wellness and activeness. And so you're seeing that in some of the inspiration here. And where that translates in our next couple slides, well, before I get into the amenities, let's jump to our next slide. The building as it's currently being approved and designed is a 6-story structure, 321 units. The difference between Tom's number and mine is because I pulled out a guest suite this week. And so that's another amenity that really a community of this size really benefits from. But it's a 321 unit community, 6-story structure. There's part of the garage that's a little bit subsurface, and that's really to take advantage of some topography along the site to really build a more efficient building. And so what you'll see in this image is kind of 3 very expansive courtyards. And so what we've done in our subsequent slides here is really try to take advantage of that. So we've got 3 different areas of the buildings where we can introduce an active use of social place like what's on the screen. At the southwest corner, we've got a pool and an amenity deck. This is a place where you can, grow your food, kind of lay out by the pool. It's more, again, adjacent to the clubhouse, which is double volume height, really gives that resort feel. We want the people on the tour path, we want prospects to walk out of the elevator on this level, which stands above Pikes Peak Avenue, and say, wow, I mean, this is like as close to a resort as I can get in Colorado Springs. In the subsequent courtyards, the second one, what we're calling Courtyard B, this goes back to the wellness piece. And so we've got a double volume fitness area with a mezzanine. And so that's over 2,000 square feet. Most of our communities are kind of in that 1,500 to 1,800 square foot size. Here, we're giving you a little bit more indoor space, but then also giving you this space to spill out onto a lawn. I mean, we have some of the best climate in the country, and we want to take advantage of that. So a place to bring equipment outside, do that exercise of your choice, and then also get out on the lawn and take advantage of yoga, gives us a really special, unique touch to this project that I think is going to really draw in the right, tenant base and ultimately value. Alternatively, on this deck, in the evening, this could be flexible for kind of outdoor concerts. You're seeing kind of the music industry shift, and a lot of that's coming in more kind of intimate settings. And we hope through our programming and management of the property, we can offer that to our tenants too, just through that social impact. And then last but not least, what's on the screen is our third courtyard. This is what gets me the most excited of all the aspects of the project. When you talk about what does the future of multifamily housing look like post-COVID, for me, it's really, what are we offering to the residents in the kind of their built living environment? Assuming that they're not going to work, or they have that by choice, the ability to work from home. We want them to be able to sit out on a leafy, shady courtyard with a laptop, or even bring in an outside person to have a meeting and give them a really nice place to do that. So the inspiration here is just outdoor workspaces to increase productivity, to give you a reason to be in the community more and to activate these spaces. This theme also translates inside of the building, where we've got 7,000 square feet of indoor workspaces. And so we've got a co-working component to this building, a singular wide building Wi-Fi system, so that if I have my computer at my desk in my unit, I'm logged in. If I carry that down to the co-working space, I'm gonna have that same login, and with that full continuity of data exists in the building. And so with that, we feel like we're really proud of how this project and its amenities are positioned in the downtown market. I think although there's been a really good proof of concept in some of the communities that have been built, what we feel like is the missing piece is institutional size and quality. And so that's what we're trying to really offer here. I think with that, I'll turn it back over to you, Tom.
So let's get down to the brass tacks of this thing. Let's talk about the project timeline a little bit, and then some returns and some volatility potential around those returns. So this project will be about 3.5 years in the making to build and stabilize, at which point we will refi out a reasonable amount of equity that should target about 2024. The expectation with that and what the base case underwriting assumes is about a new 60% loan to value refinance. With that, we would return between 20 and 25% of our investor equity at that point in time. The intent with that is to allow our investors to pay the taxes that will be coming due in 2026. There is certainly potential to achieve a higher refinance than that. We'll keep it responsible, but I think it's a conservative underwriting to assume 60% because we don't know what the capital markets will look like in 4 years from now. And the theme of my underwriting in general is not to overpromise and underdeliver. So with that baseline underwriting, we feel very confident in our ability to execute that in a very high potential to outperform. And with that refinance, they'll be generating strong yields going forward. We're estimating anywhere from 7 to 9% annual dividends coming from the property based on your initial investment amount. So really much stronger yields than we're seeing anywhere else in the market today. And that's a function of the TIF that was mentioned earlier in our ability to generate outsized returns in this market. So let's talk real quick about what the returns actually are, which is the next slide here. So this slide shows a base case investment of $250,000, what it would look like over the 10-year hold. The dark line in the middle, the dark blue line, is the base case scenario. That says if you invest $250,000 in this investment today, you'll be just about $650,000 in value in 10 years from now. That's a 2.5 net equity multiple to investors. So after fees and everything, for every dollar you invest, you'll get about $2.50 back. Of that, about 25% will be through cash flow and about 75% through residual or sale value. The shaded lines on either side of that dark line are the sensitivities. So to the upside, we've assumed a lowering of cap rate from a 5.25 to a 4.75 and a 5% higher starting rent than what we've got underwritten today. I think it's important to note that as new projects come online as we speak, the rents that we've underwritten have already shown to be a little bit low. We're about 3% below where some of the market competitors are leasing today, and that's just a function of how strong the Colorado Springs market is. As people talk about what's going on with COVID and how has Colorado Springs survived, Colorado Springs is really the only market I think we cover in any of the markets that Origin covers that not only hasn't added concessions, but it's actually eliminated concessions that were in place going into it. And we've seen positive effective rent growth in the Colorado Springs market since March, since the start of COVID. So it's really benefiting from that movement to work from home and everything else. So that's the upside scenario. If you invest $250,000, you would get about 3.1x back in 10 years from now. The downside, which has a probability of occurring as well, assumes that cap rates actually expand at a higher rate than what we've underwritten. And frankly, in what would be a pretty shocking environment to have them expand as much as would be predicted in this, and starting rents are about 5% lower than what we've underwritten, which, by the way, are already below what current market is today. So you can see your standard deviation here. I think it's a fair assumption of the upside and the downside scenarios for this investment. It pretty well captures, I think, what the likely outcome is over the next decade, which my crystal ball isn't crystal clear, but I think that this gives a great representation. The last piece I want to cover is the benefit of the QOZ, this being a QOZ investment. As you can see on the right, we're showing a 2.52x net equity multiple in our base case to investors. The column on the left is if an investor were to make a non-tax deferred, non-QOZ investment, they would actually have to generate a 3.66 net equity multiple to them in order to pay the taxes and be in the same position that you would be in if you invest in this QOZ fund. So you can see how much benefit is being generated by investing via an opportunity zone fund. Frankly, I haven't seen a deal generate a 3.6 with this risk profile since 2010, perhaps. And even then, we wouldn't underwrite it to a 3.6. So this is a really unique opportunity to generate outsized returns and just benefits even further by being in the opportunity zone. So Michael, I'll pass it off to you if you want to talk about fees or if you want to go to Q&A.
Yeah, I'll touch on fees really quickly and some of the sidecar terms here before we go to Q&A. And we're actually doing really well on time. It's about 37 after the hour, and I think we said this is going to be 40 minutes, so we're good. The minimum investment in this sidecar is $50,000. There aren't exceptions to that. We've already lowered that from what we normally do. Investors will receive a 7% preferred return on their money from the day that they do invest. And then if you are a current investor that's not in the QOZ fund or a non-current investor, there is an admin fee that you'll pay between 0 and 2%. But that fee is actually waived if you are a QOZ investor. And I would also say that if you are deciding between the fund and the sidecar, and if you do both, if you, let's just say theoretically at $300,000 and you said, hey, I want to do 200 in the fund and 100 in the sidecar, then we would waive the admin fee for the sidecar itself, so long as we can allocate you a piece of that. So that's another advantage that you can get into the sidecar and get that fee waived as well. There is a 50 basis point acquisition fee that goes to the firm on total deal size and a 15% performance fee with a catch-up as well, and then an annual ongoing 1.25% annual asset management fee on the fund that's tied to the NAV as well. So those are the fees and the terms, and that is really the end of the presentation part itself. And Tom, I think we've got quite a few great questions already, so I think we're going to go at least well into 20 minutes, and we'll answer as many as we can. But there's one here that I want you to take, Tom, because this came up at our lunch, and I thought that our guest at lunch did a fantastic job, or maybe we were the guests, and I believe he's listening today, of describing why development has passed up Colorado Springs. And this attendee asked, given all the positive about Colorado Springs, why haven't more developers been building here?
It is a great question. And really, the short answer is they're starting to now. And so the question is, why did it take this long from post-great financial crisis to gain traction in Colorado Springs? And the short answer is, or maybe the more detailed answer is, there was a shift in the political environment from a dispersed decision-making process to a highly concentrated decision-making process. And what that's done is it's made the development process, which, as Bo can attest, is extremely difficult to get through from a municipality perspective. It's made it a lot more efficient. The decision-making has been concentrated, and the support from the city has been renewed really in the last, call it 5 years. And that's through not just decision-making, but now TIFs are being offered to help revitalize the downtown market. Those are burning off. As more and more development comes to town, there will be less and less need for incentive to get developers to town. But really, it's been a shift in the political environment and a desire for the city to say, okay, it's our time. We're going to go forward with this revitalization, and we're going to incentivize developers to get moving. And so there have been developments that are occurring. There are really the proof of concept for multifamily, for the demographics that will rent these properties and these units has been proven out on a smaller scale. And really the city is just now ready for the next step, the institutional scale and the amenities that Bo was talking about. The city is right for it now.
Yeah, and it's a great question because it's one of the first questions that came up in credit committee. And I do want to say, I mean, Colorado Springs, it always comes down to economics, and Colorado Springs benefits from the halo effect from Denver and people pushing south and jobs and things like that. And we give the analogy to Denver, but it's not a Denver. It never will be. It doesn't have the same transportation hubs, corridors, things of that. But like we've seen in many other large cities around the United States, the halo effect is real. And you get the development that happens in the urban areas and then extends to the suburban areas and continues, but economics have to drive that. So the fact that we have a city here that's supporting this development and providing subsidies makes all the difference. But as Tom said, those won't be needed in a few years when this downtown is revitalized. And it's interesting with real estate, and we've talked about this, the more that you develop, the better a community gets, and it actually drives and feeds on itself. So we are going to be the premier development in this neighborhood. We're excited about that. We're certainly not the first, but I think as people see this get up and watch our project get off the ground, you are going to see developers flock. And anybody who's from a big city, they've seen how quickly an area can go from no development to all of a sudden being completely developed within 10 years. So the thing I love about this investment is that it is a 10-year time horizon, and we're positioning ourselves right in the path of growth. All right, so next question. So I think we did this already. Can you compare the Colorado Springs market now as compared to Austin? We sort of did that just now. And let me see here, Tom. So this is really about stress testing. We may have answered this already, but Tom, I'll let you take this. But based on your analysis, how would Colorado Springs fare during a recession as compared to other metro markets that Origin currently invests in?
It's also a great question. As I kind of alluded in the start of this recession that we're in currently, the effective rent growth and occupancy has actually improved in the Colorado Springs metro. And part of that is a function of being the low-cost alternative to Denver. But the other component to that is the nature of the jobs that are in place here. I mentioned the defense contracting firm that was moving next to Amazon. You've got the U.S. Air Force Academy here. You've got a tremendous amount of cybersecurity and U.S. defense contractors in the Colorado Springs market, which inherently is a recession-resistant employment base. So I would expect maybe not every recession for Colorado Springs to thrive like it has during the current recession, but I would expect it to hold up better than a market like a Houston, as an example, where it's very oil-based, and oil is, again, very volatile and can be pretty fickle. The defense spending in this country has a tendency to go up, certainly more than it goes down over time. And Colorado Springs is a big beneficiary of that.
Good answer. A couple of, so let's see here. This is a good question. This is from an investor who we know and love. Would an Amazon distribution center worker be able to afford to live at Elan Pikes Peak? Do these questions sound familiar?
We had this very conversation, didn't we, Michael? Yeah. My answer to you there in that conversation that we had about a week ago, Michael, was the pool in my neighborhood. We have 2 pools in my neighborhood, and we got lifeguards this year to help control the population density within the pool. So we had to sign up for pool times, all that stuff. The lifeguards at our pool were making $21 an hour. If you were to extrapolate that into a full-time job, that's $40,000, $42,000 a year in pay. At that level, for a lifeguard, they could afford our rents, especially in a roommate type scenario. So is it for everybody? No. Will the entry-level Amazon worker making $17 an hour be able to afford it? No. Will the guy who's been there for 3 years or a supervisor be able to afford it? Absolutely. And what's been really interesting to look at from the proof of concept new construction projects that we were talking about that are a little bit smaller is understanding the demographics that are in those apartments are substantially higher than I ever would have imagined. They're deep into the 6 figures, average household incomes. And so the demand is out there. There just hasn't historically been a product that's walkable in downtown Colorado Springs to cater to the people who want to be there. And so this is really just trying to meet the demand of what's been proven to already be there.
Right. Another question, I'll handle this. If I invest non-capital gains funds, what does the net equity multiple look like based solely upon the 10-year hold benefits? And the answer to that is 2.52. So when we are underwriting and we're presenting a net multiple, we don't factor in the benefits. The after-tax equivalent, to which Tom went over in depth, is 3.66. And all that's saying is that if you are going to, if you have capital gains and you decide, I don't want to be in QOZ and you want to pay your capital gains, you would have to generate 3.66x multiple on your equity to achieve the same after-tax benefits. Now, if your question is what are the after-tax look like on that, then that's something that you would have to equate on your side and look at taxes and things like that. But certainly, this is a deal that non-capital gains can go into, and we can actually accept non-capital gain money in the fund as well. And the returns are exactly the same, just on an after-tax basis. They're going to be a little different. Oh, I think I pressed the wrong button there. So answer live, done. So this question, what is the funding date? I'm going to answer this, Tom, for investors in order to determine what capital gains will qualify. Will capital be called up front or on a rolling basis? So for this fund, we are taking indications of interest right away. We are letting people have 7 days to firm up and confirm their indications of interest, sign subscription documents, and then fund. So the answer to your question is it will be on a rolling basis, and we will accept subscription agreements until this is fully funded, and then we were going to close the deal after that. Tom, there is a question here about the price per square foot. A quick math reveals per square foot cost is $371 per square foot. What is the reason for this high cost?
It's a really nice project. It's actually a lower cost than what we would experience in building in downtown Denver. So $370 a foot, we'll call it, is a function of building podium construction, which Bo touched on very briefly. You've got a half level of subterranean parking, plus a level of podium, and then 5 stories of stick on top of that. It's expensive to build in Denver in general, in the Denver metro. And in fact, we have a third-party consultant who reviews our construction pricing, our design, and they were comparing it against projects that they were working on elsewhere in the country, and noting that it was relatively expensive. So I compared it against the 3 other projects. Origin has 3 projects in development right now in the Denver metro, totaling just under 900 units. I compared this budget against that, but those 3 budgets as well, and we're right on par. Again, Greystar has got thousands of units under development around the country right now, so their pricing is spot on as well. It's a function of building podium construction with highly amenitized building in a market that's very expensive to build. It's challenging to get the labor here. It's challenging to get the land and everything else. It's an expensive place to build, and that's the cost of entry.
Yeah, and I would say, I mean, just dovetailing what you said, $371, just saying that in kind of a vacuum without looking at comparables and what projects are selling for, because when you go and look at the brochure, what you'll see is the comparable properties that when we're underwriting and evaluating a deal is what are equivalent projects selling for in the market. And so if our cost to build is $371, but built and stabilized projects are selling for $450 or even $500 per square foot, that matters even more than anything, because it really is market by market. You can build in some metros for $150 a square foot, but your sales price is going to be $180 or $190. And then there's some metros like San Francisco and New York where your price to build is going to be probably $800 or $900 a square foot. So it really matters. But I do encourage whoever asked that question and anybody to go look at the brochure and the comparables, and we're happy to provide more information about that. Tom, tough one. I'm going to stump you with this one. How far away? I'm going to ask exact mileage too, not even driving, but how far away is Colorado Springs from Denver?
From downtown Denver, 61.4 miles. The exact distance, that's as the crow flies. So if you got a low flying crow that has to circumvent some of the mountains, it'll be a little bit further than that. But drive time from downtown Denver to downtown Colorado Springs is about an hour and 20 minutes or so. What's really interesting to me too is with the shift that Michael mentioned down from south from downtown Colorado, the southeast suburban office market of Denver is actually the largest office market in the metro at 32 million square feet. Is slightly larger than the downtown market. And what we're seeing is folks, especially as people have the ability to get out of their office leases, office isn't dead, and this isn't an office call, but office isn't dead but it is changing how people use it. And people want more space, and there's more space in the Southeast suburban market. And if you look at that relative to downtown Colorado Springs, it's only about 45 minutes drive. And so if you live downtown Colorado Springs because you like the lifestyle, you like the access to the mountains, you like the price point, and once a week you have to drive up to your office in the Southeast suburban Denver market, or twice a week, that's something that a lot of folks will do. In fact, today there are people who live in Colorado Springs and drive up to Denver as a daily commute. And that is just going to shift even further and harder to the downtown Colorado Springs market. And as a result, and I think the city of Colorado has seen this coming for years. They're currently widening I-25, which is the main thoroughfare between Denver and Colorado Springs, has been under construction for 3 years and has probably another year of construction to it, so that it can be widened and make it a much faster travel time between the two cities.
Yeah. Thank you. So a question that came in, 319, this is about the latest return projections for the QOZ fund versus the deal, and curious how that compares specifically. So the QOZ fund, I'll just answer this, is underwritten in the exact same way. So every deal has a minimum multiple that we want to achieve over that time period. And certainly the IRR is going to be a function of the multiple, but also the timing of the refinance, cash flow, et cetera. So they're going to be right around kind of the low teens, if you will, in terms of the IRR. And so will this deal, and that refinance helps accelerate the IRR a little bit. But what I would say is that when you have an individual deal versus a fund of deals, you are going to have a much greater variance around an individual deal. So Tom talked about the projections, and one thing we've written a lot about this is that one thing we know about projections is they're wrong, right? But what we don't know is which side are they wrong to when we're underwriting a deal. Certainly that's something that the people on this call have to weigh themselves, right? Is there more upside here? Is there downside? Is this the right team? Is it the right deal? Have we taken care of the downside? What do we think here? Because certainly in our experience, where we've had almost all our deals underwrite to virtually the same project level IRR and multiple, but when you look back and actually see how they performed, they're very different. We've had 2x deals that have performed to 1.25x. We've had 2x deals that have gone to 4x and 5x, and a lot of them though, but what happens is the more deals you put into a fund, the less volatility and the more certainty you have to hit your target returns, because you have those variances on both sides. So in terms of the fund potential and this potential, they're almost identical in terms of what we're projecting, but the volatility around the fund returns will be much lower because you're diversified across geography and deals in the fund itself. So I'm going to take care of that. So will the Origin Income Plus Fund invest in this opportunity? No, it won't. This is ground up development, and the Origin Income Plus Fund does not do ground up development in this fund. So, but the Origin QOZ Fund will, as we alluded to earlier, have a large portion of this fund. So here's a question, and we've gotten this, I think, from a couple of investors, but the question is really directed at myself and David. Are we investing in the sidecar opportunity? I haven't decided yet. That's something that I might do. I'm just getting my taxes done now. I'm a little late in that, but it's not because of any conviction in this deal. It's just that David and I want to be aligned with our investors as much as possible and not look for individual deals for our money. And we believe that we're much more aligned by being in the fund in all deals rather than in an individual deal. So the question is, this year I have capital gains. I will absolutely be investing those either in the fund or this individual deal. I haven't decided yet, but it has nothing to do with the conviction here. Me personally, I like fund risk rather than individual deal risk, but we all know everybody has their own conviction around these things. I'm getting some sun here too on my right eye, so I don't know if that's coming in. I'll have to move up a little bit, but thank you for the question, and I'm happy to provide you with the exact answer when I make that decision, when David makes his decision as well. This is a good one for you, Tom, and you and Bo talked about this. We all talked about, but how has the design changed? Design of the building, I assume, changed as a result of COVID concerns?
That is a great question. And Bo and I have talked about it a couple different times, and it is something that is ongoing. And Bo touched on it a little bit when he was talking about the courtyards and the desire to create these spaces for people who are choosing and able to work from home right? So you've got the courtyard spaces where you can create a little bit of privacy. You've got the Wi-Fi that allows for you to be synced at all times with your in-unit Wi-Fi. And then on top of that, we talked about, and no final plans have been approved by everybody involved, but we talked about Murphy desks. Does it make sense to put some units that have Murphy desks so that they fold out? And if you are a work from home individual, that you can work from your unit efficiently. We've also included in the design, call it small conference room offices in the main amenity area so that you can have some private space. If you have a roommate away from your roommate, you need to make a quiet phone call, you can do that. So we are taking that into consideration. I think one of the first things that came to my mind when the world shut down back in March and Origin walked away from a lot of its projects was not only how can we continue to invest and be active, but how will real estate as a physical asset change? Because that's one of the cool parts about being in real estate is having a physical asset that you can touch, invest in, and make the best possible investment you can through the physical being. And so we're very focused on that. Bo and the Greystar team are hyper focused on making sure we get the right unit mix, get the right product, and everything syncs with a post-COVID world. So that's very much at top of mind.
Now, I'll just add a little color to that, Tom, if you don't mind. I mean, in terms of putting numbers to that, we have 28,000 square feet of outdoor amenity space. So a place where people can get out, get fresh air, spread out, and really either work out, have a meeting, work productively, or even go to the pool. I mean, those figures are big, and they're probably 30, 40% bigger than we would normally see on a 300 unit development like this. And then same for indoors. Indoors, we've got 15,000 square feet of indoor amenity space, including that 7,000 foot co-working space. So I think we definitely have a surplus of amenity space, and it gives that opportunity for people to really spread out and really take advantage of those spaces.
Thanks, Bo, for jumping in there. I know we said that we were going to honor your request to not jump in. There's some compliance issues at Greystar that Bo had asked us to honor that. So appreciate you jumping in. All right, so I'm going to ask, and maybe you can both answer this, and I have my answer as well, but what are the biggest risks of this project? What keeps you up at night? In other words, where does it go wrong? And we have a lot of questions that have come in about this, about stress testing, the deal, COVID, et cetera. We've obviously seen a huge disruption in the market to certain projects, so people are concerned. We get it. So, Tom, what keeps you up at night? Where does this deal go wrong?
Yeah, this is a fun question. What gives me pause about this is the getting it built component, right? On cost, on time, on budget. I think that's highly, highly mitigated by our partner here who has done it thousands of times around the country. But I have no doubt that if we get it built, it will lease up at tremendous rates with tremendous velocity. We've seen it in the market, and I don't have any concern there. So that would lead me to believe that, okay, I'm going to have to lean on the ability to get it built. And then I would say from there, there's always a chance that Colorado Springs fizzles, right? And in 5 years from now, it doesn't pan out. That could happen. I think it's extremely unlikely as well, but that's a risk. I think for me, though, the single biggest thing is you got to get this thing built. It's a field of dreams thing. If you build it, they will come, and I believe that.
Bo, anything to add there? Can you opine or?
My job is to really identify, mitigate, and stay up at night thinking about risk. And so this one hits close to home. I mean, but at the end of the day, this is not the type of site that we feel like we have a big swath of like, we don't know. We've done a really good job on due diligence. We don't really have concerns in the areas of soils, environmental. We like our ability to execute from a construction standpoint. Logistically, this is not a complicated building to execute on. We got a lot of elbow room. We got some extra land that helps us. To Tom's point earlier, the proof of concept just in the rents is everything. You know, so often we have to go into new markets or tertiary markets or smaller adjacent markets to bigger cities and have to bet on resetting rents. And we don't have to do that here. We can do what we do best and take best practices from the West Coast, from the Central US, from the Southeast, and all these other regions, and really just apply it to the success that's already been accomplished there. And so I don't worry about the market as much. If anything, my personal perception of Colorado Springs post-COVID is that they almost operated as if it didn't exist. I mean, for so long, early from March to April, April to May, we saw rents increasing, and we didn't see concessions except for on a select unit, literally one unit. Meanwhile, in Denver, we were seeing rents decline in some most assets, and performance kind of suffer, and we just didn't see that. So on the market side, I'm really comfortable. From a physical aspect of the building and what we're programming, I'm super excited about it. I think it's going to really be a big fly trap for all the people that we are seeing migrate to Colorado Springs. And I feel good about the real estate, the physical piece. So I don't really have that many concerns outside of kind of our normal job to just stay up and try to think about everything.
Yeah, and last thing I'll add, because we're over time here, that's our job at Origin, and it's why you pay us, is to mitigate risk. So from concept of the project to putting it together, to capitalizing it correctly, bringing in the right partners, making sure it gets built on time and on budget. And, Bo, you mentioned your company as well, and we think of ourselves, we're first and foremost risk managers. Our job from day one is to be a skeptic, to take care of the downside, and in everything, the upside is going to take care of itself. So every investment has a risk, and the question every investor needs to make out there is, does the reward outweigh the perceived risk of this particular opportunity itself? And so it's a great question. I think all of us by nature are probably people who stay up at night thinking about risk, and that's just because of maybe our DNA and the business we're in, but at our core and who we are risk managers. So I want to thank our two speakers today, Tom and Bo, for providing all the information about the project and their insights as well. And then for everybody who attended as well, we thank you very much. And I believe, we've already stated that if you have an interest in this deal, you can go online, you can look at the documents. Please email your Origin rep and provide an indication of interest. It's not binding at all, but it will help secure your spot. And I think that's it. Oh, if you, and there are obviously a lot of questions here that we didn't get to. So if you included your name in the question, we've just had to prioritize some of the questions. We don't have time. I think we could probably go for another hour on this webinar, but we will email each of you with the answer to your question. If it's an anonymous attendee and you want to email us separately and ask that question, we're happy to answer that as well. So thank you to our speakers today, and thank you to everybody who attended. Be safe.